Hello, everyone. Welcome to a Wall Street for Main Street podcast special. My name is Mo Dawoud, and today's special guest is Jeff Nielson. Jeff is the founder of Bullion Bulls Canada.com. Jeff, thank you for joining us.
Nice to be here, Mo.
Well, today, first topic, I want to get into the macroeconomic situation that we have in the economy. And, we're wrapping up the year 2012, and we're going on to 2013. I wanted to ask you, what is the one thing that happened in our economy that surprised you the most? Because I think one of the things that surprised me about 2012 is that we had two QEs being rolled out by the Federal Reserve, QE3 and QE4. I didn't think that would happen in 1 year. So what was one thing that you were surprised?
I don't really think I was surprised too much by what did happen. I was more surprised, if anything, by what didn't happen. I wasn't sure that our crippled economies could limp through 2012 without an obvious collapse. So that looks like it's coming for 2013 instead.
Yeah, a lot of people are calling for hyperinflation and economic collapse and social collapse, et cetera, et cetera. Hard to predict those kind of things. You never know when those kind of things are going to happen.
No, it's really tough to put a precise date on it, but I think that what is fairly clear to a lot of people now is that this is something that is imminent. If it's not next year, if it's not 2014, it's certainly going to be very soon after that.
Oh, I agree. I think we're in a very close range for another economic collapse, whether it's going to be the debt bubble or maybe the derivative market will collapse, or something will happen, or the education bubble will collapse. So what about going forward to 2013? What is your outlook for the economy? Do you think we'll have more stagflation like we had this year, where we had high unemployment and high inflation, or do you think we could see something different in 2013?
Well, I like the term that John Williams coined, which was hyperinflationary depression. And, essentially that's just a very, very extreme form of stagflation, where you have depressionary conditions in terms of employment, in terms of paper assets collapsing to zero, but at the same time you have a hyperinflation setting where hard assets are going to infinity. And a lot of people don't understand how these two things can occur simultaneously because we've never experienced it before. But John Williams made a very good case for it. I firmly believe that this is what we're going to be seeing, and that's what I try to express in my own writing as well.
Yeah, I think hyperinflation is a possibility down the road. For that to happen, we need an increase in the velocity of money that happens in the economy. Because right now, with all the money that's being printed, the banks are just putting it in their reserve and they're collecting interest on it. So, do you agree with that assessment that in order for hyperinflation to happen in this economy, we need to see an increase in velocity in money as well as more money printing?
Well, one of our readers brought a very interesting article to our forum a couple of weeks ago, going into detail about the German hyperinflation during the Weimar Republic. And what I found very instructive about that episode was that the hyperinflation was by no means some, steady or exponential progression. Rather, it went in fits and starts where there would be, a hyperinflationary explosion for several months, and then there would be weeks at a time where the Reichsmark would actually increase in value. And what people have to understand who don't have any background in economics is that the money printing must be translated into higher prices. This is just arithmetic. It's not a prediction. It's not a theory. It's arithmetic. It must happen. And what the German hyperinflation episode illustrated very clearly, if you look at it in detail, is that market manipulation can delay the effects of that money printing, but it can never prevent it. And so I don't think it's very wise for people to be focused on stats like money velocity, because that's something that can change very, very quickly. And all a low velocity does when the money printing itself is exponential is hide the inflation that is coming down the road. It doesn't mean it's not going to be there. It just hides it.
I agree. The bank has done a good job hiding as much inflation as impossible. One of the ways the Federal Reserve do it is they export the inflation to other countries like China that have to peg their currency to our dollar.
Well, but that game is over. Globalization was basically how they managed to do that, where they used cheap Asian labor to keep the costs of consumer goods relatively under control over in Western economies, while, as you say, they exported their own inflation to their economies. But that transition is over. We've already had our adjustment to those cheap wages, and so there's no longer any place for the Fed and the U.S. government to hide. Their activities now are going to directly translate into inflation in their own economies, subject to the fact that they can delay the effect for a little while with the various ways that they manipulate markets.
And that's a great point there. Now I want to shift gears here and talk about the precious metals market, which has been an interesting month for gold and silver. Now, the Federal Reserve rolled out QE4, and a lot of people thought we could see a little boost in gold and silver before the end of the year. Obviously, that did not happen. Today was another down day for gold and silver. Silver was around $30. At one point, it was below 30. I was kind of surprised that happened. Are you surprised with the way gold and silver reacted after the Fed rolled out QE4?
Well, going back even 6 months ago, I wrote an article called My Last Forecast for Gold and Silver Prices, not meaning that I was going to be retiring, but just that I wasn't simply going to play the game of making any sort of short-term or even medium-term price predictions any longer. Because the thing, of course, when the money printing starts to get out of control, is that the prices start to lose meaning. And in fact, about 10 days ago, I wrote a commentary literally entitled When Prices Lose Meaning, where I went down this road even further. And I pointed out a paradox here, which, it may be difficult for your listeners to grasp. So, I'd like them to sort of think about it carefully. But the way things work is as the money printing really begins to get out of control and we get closer and closer to the hyperinflation threshold, it will actually become easier to manipulate markets and thus easier to suppress precious metals prices rather than harder. And the way that works is just think of if you're holding an ounce of gold in your hand and somebody walks up to you with a big wad of monopoly money. And they say, how much do you want for that ounce of gold? Can I give you 1,000 Monopoly dollars or 10,000 or 100,000? And of course, you would just look at them like they're crazy and say, well, that's all worthless paper. It doesn't matter how much you offer. It's all the same. And this is what's happening with our own paper. As we get closer to the hyperinflation threshold, the actual difference in value between a $10 bill and a $1,000 bill goes to zero. So whether the nominal price of gold in this funny money is $1,000 an ounce or $10,000 an ounce, it's all the same. And so the fact that we did not see gold and silver prices explode with these latest money printing announcements, to me, is a very clear warning signal that we are very close to the end.
And there was a lot of people out there that thought that because gold and silver market were manipulated, the reason why the price didn't go up. As many people may or may not know, there's a very large short position in the gold and silver market, but that's in the paper market, not in the physical market. In the physical market, there's a lot of central banks, and a lot of investors, and a lot of people buying the gold and silver metals as a protection against the devaluing dollars and other countries that's going on around the world. So I wanted to ask you, do you believe there's a big gap between the silver paper market and the physical market? Do you believe if we went by the physical market that the price of gold and silver would be a lot higher than it is today?
Well, when I look around at what I've seen in the news recently, I don't even think it's a matter of talking about what people believe. I think it's been pretty much put out in the open now by the mainstream itself. It was only about 10 days ago that I saw this article in Bloomberg suggesting that perhaps they should start confiscating bullion over in India because India had this, what they called the current account deficit that they were so worried about. And I mean, this is so laughable because, of course, gold is money, and you can never have a current account deficit by trading one form of money for another. So it was just a phony issue in the first place. But it was nothing but a clumsy ruse to hide the fact that the Western bankers are getting very desperate about the lack of physical inventories, and are looking to get their hands on some somewhere. And then only about a week after that, we get this other article out from Bullion Street talking about how they had another idea how to deal with India's current account deficit, and that was to get people in India to start buying paper gold. And of course, this is even more hilarious because the only way that selling quote unquote paper gold could ease this supposed current account deficit would be if they were selling people paper and calling it gold. So, I look at those two items and I see that the mainstream press and the bankers essentially declaring out in the open, hey, we are desperately short of inventory and we're looking to try almost any crazy idea we can come up with to try to get our hands on more metal, or in the case of India, to try to discourage demand over there for real bullion.
No, I'm surprised to hear that because gold is a big part of India's culture and religion. So I find it difficult to believe they want to take away people's gold just because they're devaluing their own currency and they need to gold to protect themselves.
Well, certainly this is why I had a laugh, because the Bloomberg article was writing about this group called the All India Gold and Jewelry Association, and I mean it was obviously just some Western Front group because they were talking about looting the gold from India's temples, and obviously no Indian group would ever proposed anything that ridiculous. So, it was just a clumsy trial balloon that they had put out there in the media. And, obviously bullion confiscation is one way for them to deal with their severe inventory problem.
Now, let's talk about silver and the history of silver. There's a lot of people out there that do not know that, like gold, silver is money as well. I think a lot of people have that misconception, especially in the mainstream media, that they don't know that silver has been used as money. The last country to use silver as money, I believe, is China, and they were on a silver standard. So why do people seem to attach silver as an industrial metal, and they forget that it's a monetary metal as well, like gold?
A major part of my education here came when one of my readers introduced me to The Silver Stealers by Charles Savoy. Have you ever heard of this?
No, I haven't.
Unfortunately, Charles has not been able to get as much exposure as he should for this. It's this wonderful chronology that he's put together, dealing primarily with events in the 19th century, but also with 20th century events. And it documents precisely how the oligarchs went about removing silver from our economies, and then, of course, brainwashing us with exactly what you were saying, the idea that silver is no longer money. For instance, they've managed to more or less completely erase from the history books the fact that there was silver confiscation in the U.S. only 1 year after gold confiscation, the Silver Confiscation Act of 1934. And even a more flagrant example of them rewriting history is with respect to the Great Depression. I confess, my education, didn't begin till I read this, and what I learned from the Silver Stealers is that the real cause of the Great Depression was not some silly stock market crash in the U.S., but rather it's exactly what you were referring to. Going back to the 1920s, China and India were on, well, China, of course, was on a silver standard. They had a official silver-based economy, but India was also, highly silver-oriented economy as well. And in the early 1920s, just after World War II ended, the British went and looted all of the silver out of India. And they dumped all that silver onto the world market. They crashed the price of silver, and in doing so, they crashed both China's economy and India's economy and several other smaller economies that were also silver-based at that point. So, obviously, if you destroy the economies of the world's two most populous nations simultaneously, that's the sort of thing that causes Great Depressions, not some silly stock market crash representing 5% of the world's population. The stock market crash in the U.S. was the consequence of the collapse of China's and India's economy, which was caused by the looting of silver from India and the dumping of that silver onto the market.
Now, what's the name of that book you just mentioned?
The Silver Stealers.
Okay,
it's not a book. It's just a chronology, but you can locate it on our website, but you can certainly Google it and find it as well. And it's just a wonderful collection of various bits and pieces of knowledge. And basically, the Silver Stealers are the oligarchs themselves. And Charles connects them in all these various associations and in terms of the various events they've participated in. I have to warn readers or your audience that it's fairly slow going. You have to be fairly motivated to work your way through it, but I think it's well worth the effort to do so.
Okay, I'll have to check that out. Well, thank you for sharing that.
No problem.
There's a lot of theories on why the Great Depression happened. A lot of people blame it on the Federal Reserve and how when they started to manipulate the money supply and started contracting and expanding and contracting, that caused a boom and a bust, and that caused the Great Depression to crash, and the banks started to fail, and et cetera, and et cetera. So, there's a lot of theories out there to why the Great Depression happened. And it's not just for one entity that made the Great Depression happen, like the Federal Reserve. I believe it's a bunch of factors that have to kick in here that caused the Great Depression. Do you agree?
Well, I think in terms of the length of the event and the severity of it, that certainly you're right, that there was a lot of other things that contributed to that. My only point that I wanted to make was in terms of the actual triggering event. It wasn't the mythical stock market. Well, of course, the crash wasn't mythical, but the myth was that the stock market crash was the triggering event. And in fact, the real triggering event was the prior crashes of India's and China's economy. Once that happened, it was inevitable there was going to be a global depression. After that, of course, our government simply did so many things, incredibly poorly that they exacerbated a bad situation.
That's a very interesting theory. I want to get back to the silver supply. And, compared to gold, the silver supply is very tight and the market is very small. And according to U.S. Geological Survey, they believe silver will be extinct by the year 2020, I believe. Do you believe that's possible? That could happen?
I don't think that's a good way of putting it. I think they could have described their findings in ways that would have made it a little more acceptable to people. Because, of course, we're not going to completely run out of silver. There's, in fact, still plenty of silver in the world. The problem is that if you underprice it, grossly underprice it, it's going to be too expensive to dig it out of the ground. The fact that most of the world's silver is produced as a byproduct of other mining rather than as in primary silver mines is proof by itself that silver is extremely underpriced, because it's not, the world used to be full of silver mines, just like the world's full of gold mines. And it wasn't until the bankers crashed the price of silver in the 1990s that all those silver mines were bankrupted. Because, of course, in the 1990s, in real dollars, silver went down to a 600-year low in price when it went under $4 an ounce. So, at a 600-year low, no business can remain operating, and almost every silver mine in the world was bankrupted. And even today, there's only, 8 or 10 primary silver producers of any major size in the entire world, which is absolutely astounding given that there's still plenty of silver around. If silver was priced at $200 an ounce today, we'd have, be awash in it.
Oh, yeah, I agree there. It's just because of the rise in silver price, a lot of mines that were not economical, say, in the 90s are now economical now, and they'd be able to mine it. Plus, if you factor in that silver is an industrial metal and it's consumed, unlike gold, that makes the silver supply tight as well. Do you agree?
Exactly. The fact that silver is literally consumed, because in many of its industrial applications, it's used in extremely tiny quantities, which makes it impractical, if not impossible, for it to be recycled. So we've had a vast amount of the world's stockpiles of silver literally consumed in industrial applications and ending up in tiny quantities in landfills. According to Ted Butler's estimate, as much as 80 to 90% of the world's silver has disappeared in that manner.
Yeah, and then the cost and the planning and the difficulty of putting a mine in place and making it profitable is very hard as well due to regulations, poor management, higher input costs due to higher energy costs, which is from inflation. So if you factor all that in, it makes the silver and gold supply very tight and in high demand.
Well, and the crazy thing here is that the bankers are relentlessly shorting and attacking the mining companies. And they do this because they don't want people to be attracted to these companies as investments. But, of course, over the long term, by choking these miners as they're doing, they're strangling the supply chain and only ensuring much higher prices over the longer term.
And I want to start talking about the gold and silver stocks and the mining industry. What's your position on people owning mining stocks in their portfolio, in addition to having the physical bullions. I myself have quite a few shares in mining stocks, royalty, junior miners, and mid-tier producing miners as well. So what's your take on that?
I started investing in the miners at roughly the same time I started buying bullion. So for me, the two have always gone hand in hand. And, of course, we were just talking about the possibility of there maybe being some bullion confiscation, maybe in India, who knows, maybe in our countries again. And if bullion confiscation ever occurred, then suddenly having an interest in the miners could be the only way that people could legally hold an interest in precious metals. So for me, just like I say to people, diversify between silver and gold, I also suggest to them, if they're going to take the time to research these companies, to diversify between bullion and the shares in the miners as a way of further protecting yourself from what our criminal governments are capable of doing.
I agree. If they start confiscating silver and gold, that's very bullish for the gold and silver stocks. So, and also, the difficulty of analyzing a mining stock and the mining industry as a whole, it's a very technical industry. You got to know what you're doing. It requires a lot of homework. So wouldn't people be better off buying an ETF like GDX or GDXJ? Or
I think GDXJ is a really good starter vehicle for people because you get your own sort of list of prospective investments. People can start to become familiar with those companies. And, for me, sure, there's definitely some ins and outs to learn about mining. And it's not, a matter of just, learning in a week and suddenly you're a mining investor. But if you do spend the time to learn about these companies, I believe that the model of a resource producer is the sort of business that average people can learn to invest in if they take the time to do their homework.
I agree, and it requires a lot of homework as well. And so like I said, it's very technical. And if people need any help or looking for newsletters for to assist you in analyzing these stocks, I recommend them that they get either the Morgan Report, or they look at websites like yours and ours, and get as much homework as possible before they start getting into that. So, Jeff Nielson, I appreciate you coming on for a Wall Street for Main Street podcast. If people want to find more about your work, they can go to bullionbullscanada.com. Is that correct?
You bet, Mo.
Okay. Well, Jeff, thank you for coming on. Hopefully you can come on in the future.
Thanks, Mo. I'll be happy to come back.